Okay, we're at week 7. We're going to be talking about the zones this week. The zones are going to be the real aggressive way that we get into the market, as well as we use them for profit-taking stops. So make sure as you go through this week that we cover it and that you understand what I'm talking about and that what we're covering. If you need to go back and look at more charts, then do so. If you need to refer to your computorial, then do so. If you need to call us, fax us, or email, please, we don't mind. That's why we're here. We would rather you learn it right than have to unlearn something once you come to us and you make mistakes while you're trading. So go through, discover the zones. You're going to see how we use them to trade aggressively, how we use them as protective stops, and then we'll be back with you at the end of the week to go on to the next week. Now, zone trading is going to be a little bit different than what we have been looking at throughout the course. The first thing you're going to need to remember is that zone trading orders are going to be stop close only. If you're not familiar with that, that means that the trading at the closing range of the end of a trading day, which is the last 3 minutes, that is where you're going to be filled. So if you have a market order or you have a stop close only order in the market for let's say a sell stop at 100 and the market is closing, the closing range is say 70 to 80, well, you're going to be filled in that range of 70 to 80, not your 100 sell stop. So just keep that in mind. Stop close only is a little bit different than than buy stop orders or limit orders. Now if you're trading intraday using smaller time frames rather than a daily bar, then you're going to simply have to place a market order to buy or sell whichever direction of the market we're in. So keep that in mind. Today is going to be a pretty short day. I really just want you to understand how we create a zone, and then we'll get back in the rest of the week and go through actually trading the zones and how to use them as protective stops. So first thing we have to understand is how to create a zone. The zones are created from the AO and the AC, or the momentum and the acceleration of the market. So the first thing we want to look at, we'll start here on the first green bar. Notice the AC is green and the AO is green, and your price bar is painted green. So that's what creates the price bar. Again here, green, acceleration is increasing. Here, momentum is increasing. You have a green price bar. So if the AO and the AC both agree, then you will have, or both agree green, you'll have a green price bar. Now you notice here you have a green AC and a red AO. And notice that your price bar is painted gray, so that ought to give you a hint. This is just a little preview, but keep in mind, if the AO and the AC agree, then your price bar will be painted the same color. Now here we have the sleeping alligator, and then notice you've got green price bars. The AC is increasing, the AO is increasing, your price bar is painted green. You should start to kind of understand now. Again here, your AC is decreasing, your momentum, your AO is increasing, your price bar is painted gray. Now, next week, Dad's going to come in and explain to you how these affect the balance line. So the zones actually do more than what we're just going to be talking about this week, so keep that in mind. They're very important. And notice here you had a red AC and a red AO, and the price bar was painted red. I know we're in the green zone, but I want to just show you so you have a preview of what's coming. If the AO and the AC agree, that's what color your price bar will be. If your AO and AC don't agree, you're going to have a gray price bar. So the other reason we do this, we look at the zone trading as an aggressive way of trading, is because what we want to do is capture the most out of a move. We want to get the best average price. So notice the alligator was sleeping here. I know you can't see behind here, but there was a fractal, and we did enter the market here. So once we're in on our initiating fractal, we want to get aggressive and get the best average price for the rest of the move. So just want you to keep in mind for this evening, the AO and the AC agree. It's going to paint the price bar the same color. If the AO and the AC do not agree, they're going to paint your price bar gray. We're going to come back tomorrow, and we're going to actually get in there and look at how to create a green zone buy, and also how to create a profit-taking stop after having 5 consecutive colored bars in the market. So make sure you go to your computorial tonight, review. You're going to want to take a look at the slides in there. You're going to take a look at your video workbook manual, and make sure that you're reading about what create the zones. Have a good evening, and we'll see you tomorrow. Okay, we're back at day 2 of week 7. Today we're going to learn how to trade in the green zone and how to use the green zone to take profits. Remember, just reviewing from yesterday, the AO and the AC must agree to paint your price bar the same color. Now today we're only interested in the green zone, so we want our AO and AC, meaning the momentum and the acceleration of the market, are both increasing. So when you look at that price bar and you see a green price bar, what do you know? You know that acceleration and momentum are increasing in the market, and you want to be long, wouldn't you? You certainly wouldn't want to be short if both of those were up. So let's take a look at trading in the green zone. Again, green, green, your price bar is green. Here you have a gray price bar, you have a green AO, and a red AC. So you know at that point, we didn't know what was going on, but now it's changed to green. We know everything is up. The market is heading up. This is where we want to be. So, first thing we want to take a look at is how to create a green zone buy. First thing we need is 1 day of a green zone. So here's our first bar with the green zone, and now we're concerned only with the close. Okay, so the close of this bar, let's just say it's at 75. So the close of this bar was at 75. In order for us to add on with a green zone, the next day must be a green bar, and it must close higher. And you see it did. The next day was green, and this is the close here, and this obviously closed higher. So if I were going to place my order, I'd simply want to place a buy, stop, close only at 76, because I want it to be at least 1 tick higher than the close, so that puts me at 76, and it's a stop, close only order. So we actually got filled up here somewhere about 76 and a half, 78. I'm not sure with the numbers, but you notice that the close is definitely higher than the previous day. That's all that counts. Now, the next day happens, and what happened? We had a lower close, didn't we? So there was nothing to do. We took no action. But it does set us up for the next day. So this close was lower than the previous day, but it is green. So now we have a buy order in for this day. And we did get filled the next day. It was a green bar, and it closed higher. It's that simple. There's not a lot more to it than that. So let's go ahead and take a look at it on another slate. What I want you to see here is it takes 1 bar to create a signal. But it's going to take at least 2 consecutive green bars for you to initiate the signal. 1 bar gives us a price. The next day actually will initiate the signal. You cannot have a green zone add-on with 1 bar. It takes 2 consecutive green bars to create that signal. So here's where you add it on, and you would have added on again on the next bar. So we had 2 consecutive higher closes. It was our 3rd consecutive green bar. It took 1 to create it, but 2 to initiate the buy signal. Now let's take a look at some more green zone trades. Here's our chart. Notice that the AO, AC, and the AO are both green, and our price bars are painted green. Now, something we haven't discussed and I want to mention now. After you have 5 consecutive green bars, or red bars, at this point we're just discussing green bars, after 5 you will not take any more zone add-ons. The reason being, usually in the market you will not see more than, sometimes we'll see 8 or 9, but it's unusual, consecutive colored bars. So we want to take advantage of that and get the most we can out of the move, but we don't want to continue adding on if it's going to hurt our average price. So after 1, 2, 3, 4, 5 consecutive colored bars, you do not add on anymore. So here we've got, with each consecutive green bar, we'll place a stop close only buy from the closing price. After the 5th green bar, we will not continue to add on. So there's number 1, number 2. Now at number 2, we've circled that because we do not add on at number 2. Notice that that has a lower close. Here's number 1, there's its close. Number 2 closed 1 tick lower, so it does not count, but we do now have a buy order in for the next day. And then we have number 3 comes out, we add it on. Number 4, we add it on. And number 5 we have added on. So we added on with all 5 of these bars. Does everybody see that? 1, 2, 3, 4, 5. Start off with number 1. We had a close here, but number 2 came out and did not close higher, so we did not add on. Day 3 came out with a higher close than 2, so we added on the close at the closing price, not at our buy price. Number 4 came out, closed higher than 3. Again, we added on at the closing price of day 4. And again with number 5, we added on here. Now, yes, number 6 closed higher, but remember, after 5, we do not want to take an additional signal. We're actually going to go on and talk about what we do after having 5 consecutive bars in the next slide. But at this point, we have 3 add-ons, and we now have gotten aggressive in the beginning of the move. Notice that in this move that the alligator was asleep before we took off at the bottom here, and the alligator's opened wide. The alligator's mouth is open wide, and the market is taking off to the upside. So we have our best average price adding on in the beginning. We also had an AO and an AC buy at the high of this bar. So now you should start to begin to see how the zone trading is very aggressive, but yet it can really, really maximize your profit. Okay, so let's go ahead and take a look at another profit-taking stop, or on the chart actually. So we have 5 consecutive green bars that equals a trailing stop to go flat. Now, we use this profit-taking stop mostly in very volatile markets, like the 5-minute S&P, the 5-minute Dow, which I like to trade a lot. Anything that moves very quick, that has very large range bars, you may want to use the protective stop. It's going to give you profit. Most of the time what we see is that we're going to get in here at the low, and we always seem to somehow sell at the high, which is exactly what we want to do. Now, this is not long-term trading. This is not going to allow you to stay in for a trend, but if you simply want to hop in the market, get in there, take some money off the table, this is always going to be the stop to use. It's absolutely the best stop in that case. Also, if you are in the beginning or you're in the end, you think of a third wave and you have many of your magic bullets, you've got a squat, you've got a fractal, you've got divergence, these are things that you're going to talk about in the next few weeks, then you may want to take your profit off the table. There's going to be a lot of different situations the market will produce that will create reasons for you to make certain decisions. So just know that you have many different choices, and you're going to learn a few more throughout the course, but that the profit-taking stop is the best in a volatile market, but it does not allow you to stay in the trend. So now let's go through and look at it. Here's our first green bar. Another green bar. It's 2, 3. Now notice we wouldn't have added on 2, but we would have added on 3, would have added on 4, would have added on 5. They had they had higher closes. They were green bars and they have a higher close. That's what we're looking for. Now after 5, we would not take any more buys. We would now place a protective stop. And we use what we call it as a trailing stop. First one will be there once 6 is complete. Once 5 is complete and you're on the 6th bar, then it will move 1 tick below the low of the next bar. It will then move 1 tick below the low of the next bar. And then the next bar, 1 tick below that. Notice, so we're using a trailing stop. We're allowing the market to continue to give us profit, but we're not going to give any of our profit back. The next bar comes out, and look, that close, or that low, is lower than the previous day's low. This is where we were stopped out. Not a bad place to be. Okay, so let's review that one more time. You have 5 consecutive green bars, 1, 2, 3, 4, and 5. Then after the 5th consecutive green bar, we will not add on anymore, and we will now place a profit-taking stop, or a protective trailing stop. 1 tick below the low of each bar. Moves up, and it moves up. Now, you should not have a problem canceling or replacing your orders. Now, if you are trading intraday, as in 5-minute bars, 30-minute bars, you're going to just have to cancel and replace. Your broker should not give you a problem about that. We have no problem doing those orders. You want to make sure that you continue to follow it up, because we do not want to give back the money that we've made in the market. So 5 consecutive green bars, We added on the last 3. Now we have a trailing stop that moves up with each high or low. We want to be able to absorb anything the market's going to give us. If the market continues up, we want to make money. We want to take that. But if it pulls back down at all, we're going to be stopped out, and that was the place we're stopped out. So let's look at that on another chart. Here's another example. This is on a stock chart, and let's see. Notice I have the black bars here that have marked the 5 consecutive greens in case you're having a hard time telling with a squat bar. Remember, the squat bar takes precedence over the zone, so you just simply have to come down here and look. It's a lot easier than trying to divide range by volume compared to the previous bar. So you have 1, 2, 3, 4, 5 consecutive green bars. Now let's take a look. First one simply creates a signal. Takes 2 to initiate. So second one we bought. Third one we bought again. Number 4 had a lower close, so we did not buy on that one. And number 5 had a higher close, so we did buy again. So you had 3 add-on positions, and then we started trailing our stop. So we had our stop trailed to this point, and then the next day we were stopped out, which was great because if you look at further out in time, you're going to see the gator starting to close, the market pulled back in the gator's mouth. Look at your oscillator, look at momentum, straight down, acceleration down. So that 5-bar consecutive stop is really great in many situations. Here is where we had 11 consecutive green bars. You do not see this happen very often. This is an S&P chart, 5-minute chart. So if there's any market you tend to see that, this would be the one. Also, very volatile market, moves very sporadically, ranges are very wide. So this is definitely a place that I use the trailing stop. So we noticed we started down here with the green bars. Actually, your 5th consecutive green bar was here. Now, you weren't in the market until this point, but we're going to start counting them from where they started. There was not a break in the consecutive colors. So we did not add on anything. We got in on this one signal. We had to rely on our other signals to add on. We could not rely on the zones because there already had been 5 consecutive green bars. So our trailing stop moves up. You see with these arrows each time. It was kind of hard. I couldn't get an arrow up here, but it moved up to that bar. And you see where we were stopped out. Now, we were stopped out a little prematurely in this move, but as you see, that's okay. It might have been a little difficult to have gotten out here. You probably would have ended up with about the same price as you did with the 5 consecutive bars. But again, in the market like the S&P, that's okay because if I wanted to get back in, here was my fractal. I was in 10 minutes later. Took my profit from this move and was back in right here. So you can see that the zones actually create 2 very great ways to be in the market, trading, adding on, and also exiting. So you've learned a lot today. We're going to go ahead and finish up today now. Tomorrow we'll come back and we're going to be covering the red zone. So we're going to do the exact opposite of what we did today in the red zone. Have a good evening. Do your practice pages. Make sure you're looking at your computorial, going over Investor's Dream, and all your other resources. Have a great evening. Welcome back to day 3. Today's goal is to understand how the red zone is created and how we trade in the red zone. Now we know that from the green zone, if the AC and the AO are both up or increasing, you're going to have a green price bar. So now it's going to be just the opposite to create the red zone. If the AO and the AC agree, there's your price bar. So they're both red. Momentum is increasing to the downside, and acceleration is increasing to the downside, almost crossing 0 here. So when we look at the price bar and you look at a red price bar, what do you know immediately? Momentum and acceleration are both down. You probably don't want to be long at that time, or if you have been long, you're going to want to reevaluate the market. So let's go ahead and take a look at some charts, or I actually want to go to this next one and just show you a repeat again of 1 bar to create. So we have 1 red bar. We now have a sell stop price, or a stop close only price, excuse me. But it takes 2 bars to know if that sell stop or that stop close only sell will be hit. So it takes 1 bar to create, 2 bars to initiate. And yes, on the second bar, you would have had a stop close only sell. Now, so trading in the red zone, this should be just a little bit of review because we're going in the opposite now. Lower close on consecutive red bar equals an order to sell on the close. So what we're looking for, here's the first one. Here's your red bar, there's your close. The next bar must be red and close lower. Well, it's very obvious that that is red and that it closed lower, so we add it on. Next bar is red and it closes lower. We add it on. Now, if you have a higher close on a consecutive red bar, that's no action. No action on that bar, but you do have a sell again for the next day. So here where I'm pointing the circled area, that closed higher than the previous day, so we did not add on. But we did close lower again here, so we added on that day. It was a stop close only sell. So we actually had 3 add-ons out of the 5 consecutive red bars. Now, we have 5 consecutive red bars, so what do you know? You cannot continue to add on, can you? But I wanted to point out here you had another higher close. We actually would have had a trailing stop and you'd have been stopped out there. So, let's go ahead and take a look at it again. It takes 1 red zone to create, but it takes 2 to initiate. So, remember your AO and your AC are both red. The market's accelerating to the downside. And you've got your first add-on. You have a lower close and it's red. Now we wouldn't have actually taken the signal because it's not on the right side of the gator. This is just for practice. Second bar closed lower and is red. That would be an add-on. Third bar here closed red and lower, an add-on. This is your 5th consecutive red bar here. No more add-ons after 5, remember. 5 consecutive bars. You cannot add on, and you always have a choice after 5 whether or not you want to place a trailing stop. In this case, we didn't because, look, we weren't even below the gator yet. But in this case, you have another red bar here, so we, again, are ready to set up for another zone trade. 1 tick below the close, stop close only for the next day. And it did close lower, and it was red, so we added on here. You also have an AC signal on this bar. Next day was gray, so we didn't add on, and we didn't even have an order. But then the next day comes out, and we're back to being red, and there's our close. So 1 tick below the close would be a sell, stop close only for the next day, where it's circled. And then the next day, we have an order in, but look what happens. It closes higher, so we do not have a sell order. Again, we did not add on, but we do have a sell, new order to sell, stop close only for tomorrow. Tomorrow comes out, closes higher and gray. So you should start to have an idea now about the zones and the ideas about the zones. It's an aggressive way to trade. We want to get the best average price. We want the best position in the market. And we want to be able to get out at the best possible place. That's the end of day 3. There was not a lot here today to cover. I want you to go in and practice on your computorial again. Go to your Investor's Dream. Go to all your resources. It's very important that you have a lot of practice with these before you actually place your money in the market. The zones, again, I stress, are one of our aggressive ways of adding on in the market, but the 5-bar protective stop or the profit-taking stop is a real good place for beginning traders to make sure that you're not exposing yourself too much. As you become more experienced in the markets and you trade more, you're going to find yourself able to use other stops, able to take different risks, and following your belief systems. So have a great evening, and we'll see you tomorrow. Today we're simply going to cover how to take profit using the red zone. This is day 4 of week 7. We're almost to the end, so let's go ahead and take a look at taking profits. Let's remember 5 consecutive red bars equal a stop to go flat 1 tick above the high. So here's a chart. Here's our first red bar. There's our second consecutive, third, fourth, and fifth. Now, let's take a look at how many actually add-on sales we would have had real quick before we go on. Here's your first red bar, so you have 1 to create, 2 to initiate, so we added on the number 2. Did not add on number 3 because it's a higher close. We did add on number 4, and we did add on number 5. So you had 3 add-ons out of your 5 consecutive bars. Now we're going to use a trailing stop. So let's take a look at how that's going to work. First trailing stop is going to be 1 tick above the high of that bar. It's then going to move down as the market moves down. It's going to then move, that's exactly the same, so it really doesn't, you don't have to actually change that order, but you would if it was a different number or lower. That moves down. We change our trailing stop one tick above that high. And we change it again here one tick above the high. And we're stopped out on this next bar. That high takes out this high. So notice we had the profit, we took profit all the way down, and we were stopped out on this bar. It was not a bad exit spot. So you see how the trailing stop can work. We don't want to exit the market if the market's going to continue to give us profits or continue in the same direction. But if the market's going to pull back, especially having that many consecutive red bars, we want to take our profit off the table, and then we'll re-enter again with the fractal. Now, here's another chart. This one's a little more busy, but let's go ahead and talk about it. Here is your first red bar, and I've put squares around the add-ons. It had a lower close. Notice here, there's nothing around it. It closed higher, but it did give us a price to add on for the next day. And you see the box has got a square, so we did have a lower close than that day, so we added on here. And then again here we added on. We had a lower close. Now, that's also the 5th consecutive red bar. After 5, remember, we do not want to take any more add-on positions. So we have now moved our stop from the alligator to a trailing stop, one tick above the high of each of these bars. And you see how we just move it down, continue to move it down until we're taken out. And this is the point that we exit this move. So again, you can see how the zones really help us to increase our profit and lock in our profit at the same time. Now this is a natural gas chart on a 30-minute. It's also kind of a volatile chart, so we like to get in and out of this chart. In this case, we had 5 consecutive red bars, and then we were stopped out. Now, I put the lines here again because it was a little difficult finding your 5 consecutive bars. Okay, so here's our 5 bars, and this one is circled because this is where you were stopped out if you'd have used a trailing stop coming down. Now, you also see what happens with the gator. You see everything starting to close up. The gator's starting to shut his mouth. You have squats here. You have a fractal on the bottom. You also had a change of momentum. So some things were starting to happen in the market conditions as well. And that's the end of day 4, week 7. We have, so far this week, we have covered green zone buys, red zone sells, and protective stops in the red zone and in the green zone. Tomorrow we're going to come back and just kind of recap and talk about the gray zone a little bit. I know you haven't talked about that this week, so you need to understand what the gray zone does as well. So have a good evening, and we'll see you again tomorrow. Okay, welcome back to day 5 of week 7. This is the last day this week, so let's go through and examine the gray zone and just recap the trading in the zones and the protective stops. We've been talking about the red zone and the green zone, but we have not mentioned the gray zone much. The gray zone, as you should now be able to tell, is created by the AO and the AC when they don't agree. So if the AO and the AC are different colors, it does not matter which one is which. The AC could be green and the AO can be red, or vice versa. They will create a gray price bar for us. Now, by looking at the gray price bar, all it says is that we don't know. We know that the momentum and acceleration are not in the same direction. We will not know which one is which until we actually look at that. So when we're in the gray zone, we don't add on, we don't do anything different, we just trade normally. Now, if you're using a protective stop and you're in the gray zone, you will continue to trail it down. Once you've created the 5 consecutive bars, it does not matter what color the bars are until you're stopped out. So the gray zone is created by the AO and the AC when they don't agree. So notice in the area circled, no action taken in the gray zone. There's nothing to do. Even though there are higher closes and even lower closes, we're not adding on. It must be when the AO and the AC agree, because we want the market to be pushing strongly in one direction. When they don't agree, they're not. They're confused. They're not sure. You notice here we've now gone into a red zone at the end of the chart, and you actually had one add-on zone trade, stop close only. So here you really get a picture of all 3. We have one green zone here, we have the gray zone, and then of course we have the red zone. So AO and AC agree, green bar. AO and AC don't agree, gray bars. AO and AC agree, red, we have red price bars. And remember, if the squat bars will take precedence, so if you have a blue bar on your screen, you'll simply have to go down and look at the AO and AC to see what color the bar would be, what zone it is. Now, here's another green zone. That's an add-on, that's an add-on, and that's an add-on. Shouldn't have taken you long to see that. All you're looking for is the closing price, and the closing price must be higher than the previous day, and it must be green for a buy. Stop, close only, one tick above the high. So you had 3 here, 1, 2, and 3. Now to recap again, here's your green zone, your gray zone, and your red zone. Remember how these are created. It's very simple. Once you've got it, it should be no problem. All we're looking at are closing prices. And your trailing stop, that's your other thing. Once you've had your 5 consecutive bars at this point, we'll then place a trailing stop, 1 tick above the high of each bar until the market takes us out. Okay, so you've gone through. You should now have a good understanding about the red zone, the green zone, the gray zone. You know that you're only going to be adding on in a green zone with a higher close, consecutive green bars. You know that after you've had 5 consecutive colored bars, if you are in a volatile market or you're not staying in a trend, or maybe your magic bullets are in, whatever your reason, you will use a 5-bar trailing stop until the market takes you out. Now we know it doesn't matter what color the bars change to after you've had your 5 consecutive bars. So if you have any questions or you're not sure, again, I always say this at the end of the week, please review, please go back, give us a call, let us know, review your computorial, but always do your IT date with yourself. It's very important that you treat yourself well. You are the most important person. Have a good weekend, and you'll be back with Dad on Monday.